Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate jargon to find the real story. And boy, do we have a story for you today with Citius Oncology, a company fighting cancer, but also fighting to stay afloat. Let's see what their latest filing filed with the SEC tells us about their fight, or maybe more accurately, their struggle. This is an update to their registration statement, essentially a business plan filed with the SEC, which means they are looking to either sell more stock or make some other significant corporate move, like raising money for their key product Limpia. So Citius Oncology, a company focused on cancer treatments, is gearing up to sell more of its stock. They're planning to offer up to about 5.3 million shares of their common stock, along with warrants, which are like options to buy more stock later. The price they're aiming for is around 2 to 82 cents per share. This is how companies like this raise the cash they need to develop their drugs, but also means they're asking investors to fund their operations, which often means they're not making enough money yet to cover their own costs. The plan here is to sell shares and warrants together. They want to sell about 5.3 million shares of their common stock, and with each share they're also selling a warrant, which is basically a ticket to buy more stock in the future. The price they're aiming for is $2.82 for the share and the warrant combined. This is a typical way for companies like this to raise money, but it also means they're selling pieces of the company to fund their ongoing operations. You can find their stock on the Nasdaq stock market, trading under the ticker symbol CTOR. This is important because it means their stock is available to the public. They've hired a company called Maxim Group LLC to help them sell these shares. Maxim's job is to find people who want to buy the stock, and they'll be getting paid a commission for their work. Now, as always with these kinds of filings, they're reminding everyone that investing in their company is risky and you could lose all the money you put in. This is a standard warning, but it's especially important for biotech companies that are still developing their products. Let's dive into the financial health, or lack thereof, if you will. Here are their main financial statements for the years ending September 30, 2024 and 2023. Let's look at their balance sheet, which is like a snapshot of what they own and what they owe at a specific point in time. As of September 30, 2024, they had a tiny amount of cash, just $112. Compare that to the $0 they had at the same time in 2023. Not much of a change there. This tells us they're really scraping by on cash. Their inventory jumped significantly from $0 in 2023 to over $8.2 million in 2024. This is likely related to their drug Limpia, meaning they've actually produced some of their product, which is a good sign for commercialization. Now, this is a big one. They had $73.4 million booked as in-process research and development. This is essentially the value of the drug Limpia they acquired, the money they've spent on research that hasn't quite turned into a finished product yet. It's an intangible asset because it's not something you can physically touch like a building, but it represents the core value of their development efforts. They owe almost $28.4 million for licenses, and this amount is the same as last year. This is for rights to their drug Limpia, and it shows the significant financial commitments they have to make. And there's a note payable to a related party, which is Citius Pharma, their parent company, for $3.8 million. This is money they owe to their own company, which isn't ideal. And then there's the accumulated deficit, which is basically their total losses since they started. It's a staggering $39.2 million by September 2024, up from $18.1 million in 2023. This number shows they have a long way to go to become profitable. They're losing money, and a lot of it TED. Now let's look at their income statement to see how they're losing money. This statement shows their revenues and expenses, and ultimately their profit or loss. Their total operating expenses more than doubled from $12.1 million in 2023 to $5 million in 2024. This has been driven by increased spending in both research and development and general administrative costs. And look at this, stock-based compensation jumped from $1.9 million to nearly $7.5 million. This is the cost of giving stock options to employees and executives. And this big jump suggests they've been trying to attract and retain talent using stock as a sweetener, especially given the company's current financial situation. As a result, their net loss has widened significantly. They lost $21.1 million in 2024, a big jump from the $12.7 million loss in 2023. This is not a company that's making money. They are burning through cash to develop their product. Then let's look at the most recent quarter. These are their unaudited results for the first 3 and 6 months of 2025 compared to 2024. For the 3 months ending March 31, 25, their net loss was about $7.08 increase from the $4.8 million loss in the same period last year. And for the 6 months, the loss was almost $14.4 million, up from $9.5 million. The trend is clear. They are losing more money as time goes on, and their expenses are rising fast. Research and development costs are also soaring. For the 3 months ending March 31, 2025, it jumped to over $3 million from $1.3 million in the prior year. This is likely tied to getting their drug ready for commercial launch. And general and administrative costs similarly jumped to $222 million in the recent quarter from $123 million a year ago. Again, likely due to efforts to prepare for the commercial launch of Lantus. Now this part is a bit tricky. The weighted average common shares outstanding increased from around 67.5 million in 2023 to over 71.5 million by March 2025. This growth in shares outstanding, even though they aren't profitable, could eventually lead to something called dilution, where each existing shareholder owns a smaller piece of the company. This often happens when companies issue more stock to raise funds. This is a critical heading. Their own accountants are flagging that there's serious doubt about whether the company can continue to operate. This is a huge red flag, meaning they might not be able to pay their bills or stay in business without more money. They explicitly state they need a lot more money, even after this stock offering, just to keep things going and get their drug to market. They aren't sure if they'll get this money, or if they do, if it will be on good terms. If they don't get the funding, the company could have to shut down. This is their salvation and their greatest risk all in one. They only have one approved product, Limper, and everything hinges on its success. If Limper doesn't take off, they're in serious trouble. Even if Limper is approved and people start using it, they might not be able to charge enough for it, or insurance companies might not cover it well, which would hurt their income. Getting approval to sell is one thing, getting paid for it is another. Here's a conflict of interest alert. Citius Pharma owns a huge chunk of this company, over 92%. This means Citius Pharma pretty much calls all the shots. While this can provide stability, it also means their interests might not always align with smaller outside investors. Citius Pharma could make decisions that benefit themselves even if it's not the absolute best for everyone else. So what's the verdict? Citius Oncology is in a precarious position. They have an approved drug, Limper, which is their lifeline, but they are burning through cash at an alarming rate and relying heavily on external funding. The big jump in inventory suggests they're moving towards launching Limper, which is positive, but the massive accumulated deficit and the going concern warning from their auditors are very serious concerns. They are a classic high-growth, high-risk biotech play. If Limper is a hit, they could rebound, but the odds are certainly against them right now. It's a bet on the drug's success and their ability to secure much-needed funding. What's your take, these numbers, and what they signal for the company's future? Let us know in the comments below. If you enjoyed this deep dive and want more of these straight-up analyses, hit that like button, subscribe to Corporate Decoder, and don't forget to join our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and we'll see you next time.